Hey guys, big news in the financial markets this week. As you probably know, the Fed recently signaled the end of rate hikes and also indicated the potential for rate cuts sometime in the near to midterm. I've been keeping a close eye on the Fed's moves lately, and I thought I'd share some insights on what their December rate pause means for us in the real estate world. First off, you know how we've been seeing a near constant rate hike schedule since March 2022? Well, it seems like there's finally a breather in sight. The Fed decided to keep interest rates steady for the third consecutive time during their meeting. What's got everyone talking is that they're hinting at interest rate cuts next year. Actual cuts, right? Can't believe it. Anyway, CNBC reported this, and it's big news because it suggests a shift in economic strategy that could spell relief for real estate investors, home buyers, and sellers. Now let me break down what this could mean for us. For starters, those aggressive rate hikes have really driven up borrowing costs across the board. It's been tough for commercial real estate investors and home buyers alike. You remember how investment sales took a nosedive and building owners, especially in office sectors, were scrambling to refinance? That was all tied to these increasing rates. But with the Fed signaling potential cuts, 3 of them next year at 0.25 percentage points each, we could see some of those pressures ease off. Here's where it gets even better. If things go according to plan, and let's hope they do, the Fed looks set to cut interest rates by a full percentage point through 4 increments in 2025, and then possibly another 3 reductions by 2026, which would bring us back down to between 2% and 2.25%. So imagine that, a future with lower borrowing costs again. Although Moody's Analytics says we might still see a slow transaction market within commercial real estate early next year, things could pick up later on. And what about home buyers and sellers? Well, mortgage rates are already responding positively to all this talk about rate cuts. They peaked last fall over 7%, but have since dipped slightly before rebounding again, sitting around 7.21% as of mid-December, according to Bankrate. While the Fed doesn't directly set mortgage rates, they tend to follow the yields on 10-year treasuries. Its policies definitely influence them as well. See, as inflation cools down, it's now closer to the official target of 2%. Economists from the Mortgage Bankers Association believe we might be nearing the end of this tightening cycle. They claim this path should support further declines in mortgage rates just in time for spring, which is traditionally prime house hunting season. But here's something else interesting. Even though higher mortgage rates can dampen housing demand, since people face steeper monthly payments and sellers get lower offers, history shows that housing markets can be quite resilient over time, despite rising rates. Remember how crazy high mortgage rates were back in the 80s? People still bought homes. Same goes for the 90s, and even during the housing bubble from 2004 to 2007, when prices soared despite higher than average mortgage rates. Sure, our current market has cooled down from its red-hot state during the pandemic recovery phase, with slowed sales volume and fluctuating prices, but long-term, we've seen that life events prompting home purchases don't always line up with favorable mortgage rate cycles. And if these anticipated Fed rate cuts come through as predicted, affordability might become less of an issue, though it could mean more buyers jumping into an already tight housing supply market, which is something sellers would welcome. So, yeah, while we can't say anything with absolute certainty when it comes to economics or real estate markets, for now at least, it seems like there's reason for cautious optimism among buyers and sellers alike. That's going to be everything for now, and remember to like and subscribe, and we'll see you next time here at Urban Assets. Thank you so much. Bye-bye.